March 26, 2021, 9:30 a.m. Eastern. In the next 6 hours, global banks will lose over $10 billion. The trigger isn't a hedge fund. It's a little-known family office in New Jersey. It doesn't disclose its positions. It isn't regulated like a fund. And 8 of the world's largest banks don't realize they're all financing the same hidden bet. On April 27, 2022, the U.S. Attorney's Office unsealed an indictment. 4 individuals, 11 counts, racketeering, wire fraud, market manipulation. According to the SEC complaint filed the same day, Archegos Capital Management had operated for 8 years using practices regulators later described as market manipulation. At its peak in March 2021, the firm controlled exposure to securities worth approximately $36 billion. The founder, Bill Hwang, known as Bill Hwang, a former protege of Julian Robertson at Tiger Management, one of the most influential hedge funds of the 1990s. In 2012, Hwang's previous firm, Tiger Asia, settled insider trading charges with the SEC for $44 million. 3 months after that settlement, in early 2013, Hwang restructured. He created Archegos as a family office, managing only his personal wealth. Under U.S. law, family offices are exempt from SEC registration. No position reporting, no external audits, no public disclosure. The instrument Archegos used was a total return swap, or TRS. In a total return swap, the bank purchases the underlying stock and holds it. The client, Archegos, receives all economic gains and losses, plus dividends. In exchange, the client pays a financing fee, but the client never owns the shares. Under Federal Reserve Regulation T, purchasing stock on margin is limited to 2-to-1 leverage, but swaps are not subject to Regulation T. Archegos routinely operated at 5-to-1 leverage, sometimes higher. More critically, because the bank held legal title to the shares, Archegos avoided triggering Schedule 13D filing requirements. Under SEC rules, acquiring beneficial ownership of 5% or more of a company's stock typically requires public disclosure within 10 days. Court records show Archegos accumulated large swap positions across a concentrated group of stocks. These included Viacom CBS, Discovery, Baidu, IQIY, and GSX Tekadu. In several cases, those positions were extreme. More than 50% of the outstanding shares in IQIY, over 60% in Discovery, and more than 70% in GSX Tekadu. No disclosures were filed. At this point, nothing Archegos was doing was illegal on its own. The risk was not in any single trade, but in how these structures interacted. Archegos fragmented its positions across at least 8 global banks: Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS, Deutsche Bank, Mitsubishi UFJ, Wells Fargo. Each bank could see only its own exposure. None had visibility into the aggregate position. Between January and March 2021, the price of Viacom CBS stock rose from $40 to $101, a gain of 152% in 10 weeks. The company had not released material positive news. Earnings were stable. Analyst recommendations were mixed. According to the SEC complaint, Archegos deployed a pattern: aggressive buying in pre-market sessions to set the opening tone, then concentrated buying in the final minutes of trading to mark the close. The mechanics functioned as a self-reinforcing cycle. As stock prices rose, the value of Archegos collateral increased. This created excess margin at the banks, which Archegos withdrew and immediately reinvested into additional swaps on the same stocks. Internal risk systems at the banks flagged concentration risk as early as 2019. A 2021 independent report commissioned by Credit Suisse found that in 2019, the bank earned $17.5 million in fees from Archegos, while maintaining exposure of approximately $20 billion. A risk-to-revenue ratio of over 1,000 to 1. Court records include emails from risk officers requesting increased margin requirements. Those requests were overruled by business-side executives who cited competitive pressure, the concern that Archegos would take its business to another bank. In testimony during the 2024 trial, William Tomita and Scott Becker, both Archegos employees who cooperated with prosecutors, stated they were instructed to lie to banks, specifically to misrepresent the size of positions held at other banks, and to overstate the liquidity and diversification of the overall portfolio. On March 22, 2021, Viacom CBS announced a secondary stock offering. The company sought to raise $3 billion. The market interpreted the offering as dilutive. On March 23, Viacom CBS shares fell 9%. For Archegos, this was not a price move. It was a leverage event. In a portfolio levered 5-to-1, a 9% decline erodes 45% of equity capital. For years, leverage amplified gains. Now, it began amplifying time. Margin calls went out. Archegos could not meet them. On March 24th, Viacom CBS fell an additional 30%. The decline spread. Discovery dropped 27%. Tencent Music fell 20%. Baidu declined 13%. On the evening of March 25th, Archegos convened an emergency call with its prime brokers. Hwang's team admitted the firm did not have the liquidity to meet margin obligations. Credit Suisse proposed a coordinated liquidation, a managed unwind to avoid market panic. The proposal failed. The banks did not trust each other. They did not trust Archegos. March 26th, 6:00 a.m. Goldman Sachs and Morgan Stanley began executing block sales before the market opened. Billions of dollars in Viacom CBS, Discovery, and Baidu shares hit the market simultaneously. Viacom CBS fell 27% in a single session. Discovery fell 27%. Viacom CBS volume, 211 million shares, 10 times the daily average. Goldman Sachs, minimal losses. Morgan Stanley, losses contained. Credit Suisse, $5.5 billion. Nomura, $2.85 billion. Credit Suisse shares fell 14% in 2 days. Aggregate losses across all counterparties exceeded $10 billion. April 27, 2022. Bill Hwang and Patrick Halligan, Archegos CFO, were arrested. 11 charges: racketeering, wire fraud, securities fraud, market manipulation. The trial began in May 2024. William Tomita and Scott Becker testified for the prosecution under plea agreements. Becker, Archegos' chief risk officer, testified he was told to provide banks with false assurances about portfolio concentration. Tomita, the head trader, testified he was explicitly instructed to misrepresent positions. On July 10, 2024, the jury returned a verdict. Hwang, guilty on 10 of 11 counts. Halligan, guilty on all counts. November 20, 2024. Sentencing. Bill Hwang, 18 years in federal prison. Patrick Halligan, 8 years, sentenced January 2025. The court ordered restitution of over $9 billion. The regulatory response followed quickly. In February 2022, the SEC proposed Rule 10b-1, requiring public disclosure of security-based swap positions above $150 million, or 5% ownership. The rule was withdrawn in 2025 after industry opposition. Amendments to Form PF, the confidential reporting regime for private fund advisors, were adopted in February 2024 to increase systemic risk monitoring. The compliance deadline has been extended twice. Current deadline, October 1, 2026. Credit Suisse raised $2 billion in emergency capital. The CEO of its investment bank resigned. The chief risk officer resigned. In 2023, the bank was fined $387 million by US and Swiss regulators for failures in risk management. In March 2023, Credit Suisse was acquired by UBS in a government-brokered emergency merger. The failure of Archegos was not a failure of information. Each bank had data. Each bank had models. Each bank had risk committees. What they lacked was coordination and visibility. The instrument that enabled the scheme, the total return swap, remains largely exempt from the disclosure rules applied to direct stock ownership. The structure that concealed it, the family office, remains exempt from SEC registration. The regulatory gap that allowed $36 billion in exposure to accumulate invisibly was not closed. It was deferred, without a deadline.